Imagine this, you are the breadwinner of your family, taking care of everything: bills, loans, your child's education, maybe even parents' medical expenses. Now, what happens if life throws an unexpected curveball? What if you're not there tomorrow? Scary thought, isn't it? And yet, most of us avoid the conversation about life insurance. It's uncomfortable but absolutely necessary. Without a financial safety net, your loved ones could face a double burden: emotional loss and financial chaos. But here's the good news, you can change that narrative starting today. So, what is life insurance? First, let's strip it down to the basics. Life insurance is a contract where you pay regular premiums, and in return, the insurance company provides financial protection to your loved ones if something happens to you. Think of it as your family's financial plan B. You hope they'll never be needed, but it's there just in case. You can understand it with a simple analogy. Imagine life insurance as a sturdy umbrella. You don't always need it, but when the storm hits, you'll be glad you have it. So, why do you need life insurance? Now, you might ask me, Nikhil, why should I give someone my money when I won't be able to use it myself? But this is not about you, it's about those who are dependent on you. If you're single and have no responsibilities and also not planning to have a family, I myself would tell you to switch off the video now. However, if you are the primary or one of the providers for your dependents and have a significant amount of debt that overweighs your assets, then insurance can help ensure your loved ones are well provided if something happens to you. Having a life insurance policy may also make sense if you own a business or co-sign debts such as a private student loan for which someone else could be held responsible if you pass away. Life insurance provides a financial blanket to those who are dependent on you. It will give you a lump sum amount in case of tragedy or a return after a fixed period of time based on the policy you have opted for. We will talk about this in our next section. So, what are the types of life insurance? By now, I'm sure all of you must have heard about term life insurance or endowment plans when the conversation is about life insurances. Today, I will clear your doubts surrounding the same. Life insurance comes in various varieties based on your need. Term life insurance. This is pure protection. It offers full and assured protection at an affordable premium. However, there is no maturity benefit. You don't get anything if you outlive the policy. These are best for breadwinners looking for cost effective safety. Endowment plans. This combines insurance with savings. If you survive the policy term, you get a lump sum payout. In case of death during the policy term, your nominee also receives a death benefit. Endowment plans are quite flexible. You can choose a suitable method and time frame to pay the premium. The returns generated on a maturity from an endowment plan are also tax-free. The premiums can also be claimed as a deduction under Section 80C of the Income Tax Act. So let's understand with an example. Mohit, aged 35, buys an endowment plan for a policy term of say 20 years and a premium paying term of say 10 years. He pays an annual premium of 30,000 and has a sum assured of 3 lakhs. At an 8% return, the maturity benefit would be about 7.21 lakhs. At a 4% return, his estimated maturity benefit, including guaranteed additions and terminal bonus, will be about 4.47 lakhs. Money back policy. This is another common term that people have heard of but don't know much about. A money back plan is a life insurance policy where the insured person gets a percentage of the sum assured at a steady interval. Since you save regularly, the money back plan rewards you regularly. In simple words, a money back plan is an endowment plan with the benefit of increased liquidity with systematic payouts. Money back plans are designed to help you meet your short term financial goals. The money back feature can add to your monthly or yearly income. Let's also understand this with an example. Let's say Rohan bought a money back policy worth 10 lakhs with a premium term of 20 years. It has a survival payouts of 20% assured every 5 years. So at the 5th year of policy, Rohan would receive rupees 2 lakhs, which is 20% of 10 lakhs. At 10th year, he gets another 2 lakhs and so on. Should he not survive thereafter, his nominees will receive the full sum assured of 10 lakhs, even though Rohan already received 4 lakhs in survival benefits. People go for this policy because it is useful for meeting periodic financial goals and provides guaranteed returns. ULIP, also known as Unit Linked Insurance Plan. It is a combination of insurance and investment. A ULIP provides life cover that offers financial protection for your loved ones. In addition, it also provides you the potential to create wealth through market linked returns for systematic investments. A ULIP offers you the opportunity to invest your money in different fund options depending on your risk appetite. ULIPs come with a 5-year lock-in period and the money can be invested in bonds, equities, hybrid funds, etc. depending on your risk appetite. If you're looking for safer options, bonds can be a good choice. On the other hand, if you are open to more risk, hybrid funds and equities have the potential to offer better returns. Another popular category of life insurance is whole life insurance. It is for those who are looking for protection for your family for a longer period of time. A whole life insurance plan is a life insurance policy that gives you life coverage for 99 years. It helps you build a cash value over time. While there are many options, I would say just stick to either term or whole life insurance, and the others may not be worth it. Why? I will talk about it soon. But keep in mind that life insurance by itself doesn't cover every situation. For example, a standard life insurance policy won't pay out if you develop a chronic illness, nor will it cover long term nursing care costs. Still, you can purchase chronic illness riders or long term care insurance riders for an additional premium cost that can provide living benefits to cover those types of scenarios, which is a topic of discussion in the later parts of this video. Now, before you buy a life insurance, there are few things you must consider. Calculating the amount of money your dependents will require is a major factor in selecting a life insurance policy. A number of variables influence the face value or the sum that your policy will pay out in the event of your death. One person's minimum coverage needs may differ significantly from another's. While your personal number may be higher or lower, financial experts generally advise getting at least 10 times your yearly income in coverage. Another key consideration before taking life insurance is your debts, because the money received from life insurance policy can be used to settle outstanding debts such as credit card debts, personal loans, mortgages, auto loans, and student loans. Your policy should cover enough to cover all your debts if you have any of these. You should also take out a little more to settle any extra interest or additional charges. Replacing your income is one of the primary goals of life insurance. If you earn 20 lakhs a year and are the only provider for your dependents, you will require a policy payout that is sufficient to replace your yearly income, plus a little bit more to protect against inflation. Experts in life insurance advise getting enough coverage to cover at least 10 years worth of income. So a life insurance cover of around 2 crores in this case. You can start comparing life insurance policy after you have established the required face value. You can use an online insurance estimator or speak with an agent to find out how much coverage you will require. All these considerations are great, but you know what makes it even better? Add-ons or riders. Think of them as the extra toppings on your pizza, a small addition that can make a huge difference. Here are 3 must-have riders that can supercharge your life insurance policy. Critical illness cover. Imagine facing a major illness like cancer or heart condition. Scary, right? This rider ensures you're covered financially during such tough times by providing a lump sum to cover treatment cost. It's like having an extra financial cushion when life throws you a curveball. Disability rider. Accidents can happen to anyone. If you're permanently disabled and unable to work, this rider steps in to provide a steady income, ensuring your financial responsibilities don't take a hit. It's your financial safety net when life changes unexpectedly. Premium waiver. What if you can't pay your premiums due to critical illness or disability? Don't worry, this rider ensures your policy stays active even if you're unable to contribute. No stress, no interruptions, just continued protection for your loved ones. Quick tip, riders are affordable and significantly enhance your policy. So while choosing life insurance, don't just look at the base policy, add these riders to truly customize it for your needs. To buy life insurance, you can also follow the rule of DIME. It breaks your financial needs into 4 categories to ensure your loved ones are covered for all life's essentials. You calculate all your debts like your loans, credit cards, etc., and take a policy that can cover all of them. Then you multiply your annual income by 10 to 12 to cover living expenses. If you have got a home loan or a mortgage, add the outstanding balance to your coverage. You wouldn't want your family worrying about paying EMIs or losing the roof over their heads. And finally, think about your kids' future education costs. Whether it is school, college, or even professional degree, life insurance should ensure their dreams aren't derailed by financial troubles. So if you estimate that your child's education cost will be about 20 lakhs in the future, include that in your policy's coverage. All right, now that you have covered the what and why of life insurance, now let's talk about how. Buying life insurance doesn't have to be overwhelming if you break it down into simple steps. Here's a quick guide to help you get started. And yes, we are keeping it stress free. First things first, ask yourself how much coverage do you really need? And what type of policy should I opt for? Remember earlier I mentioned sticking to term insurance or whole life cover? That's because mixing investments with insurance isn't the smartest financial move. Here's why. When you buy a traditional insurance plan like an endowment or a money back policy, a significant portion of your premium, sometimes 30% or more, goes towards agent commission and administrative cost. That leaves less money actually working for you. Now, imagine this, you're paying for a policy that claims to give you a life cover and savings, but for your premium to deliver both, it has to work much harder, often harder than market can realistically manage. The result, subpar returns on your investments. Instead of bundling insurance with savings, buy a term insurance policy for your life cover. A 1 crore term insurance policy for a 30-year-old might just cost 12 to 15,000 per year. Compare that to an endowment plan which costs around 1 lakh annually for the same 1 crore cover. The term policy actually costs a fraction, leaving you 85,000 rupees plus every year. Invest the difference in SIPs or equity mutual fund. To address this and tell you which is better, let's do a math. If you invest 85,000 annually in an SIP with a 12% annual returns, you will actually have around 70 lakhs after 20 years. With an endowment plan, the payout might barely touch 20 to 30 or even 40 lakhs, and that too with a poor liquidity. So by splitting insurance and investments, you save on premiums, get superior returns from your investments, and you can retain flexibility as SIPs or mutual funds can be adjusted based on your goals. Take some time to compare policies online. Aggregator websites are super helpful for checking premiums, features, and reviews. And here's an insider tip. Always check the company's insurance claim settlement ratio. A higher ratio means they're more likely to honor claims promptly, something you definitely want when your family needs support. Also, the faster you enroll, the lower your premium. The later you take up the insurance, your mortality risk increases, which results in your premium shooting up exponentially for the same cover. And if you're still feeling unsure, need not worry, consult a professional insurance agent. They can guide you based on your specific needs and explain the nitty-gritties of the policy. Buying life insurance is more than just ticking a box. It's about giving your loved ones the financial security they deserve. Take it step by step, ask questions, and choose a policy that truly fits your needs. So, if you have got more questions about life insurance, drop them in the comments below. I'm here to help. And if you found this guide helpful, don't forget to like, share, and subscribe. That's it from me. I'm Nikhil Varghese, and here we learn how to make your finances less tricky with FinNiki.